Hello and welcome to episode 298 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How you doing?
I'm excited, Andy, about tomorrow's live event. So if you haven't heard, I'm hosting a Money to the Masses live event all about ethical and sustainable investing and whether ethical and sustainable investing can improve the world and your wealth at the same time. And now it's going to be a great event. I know that's a bold claim for a live event that's not yet occurred, but it's going to be a really good event. I've got Alice Ross from the Financial Times, who's written a book on climate investing, and Moira O'Neill from Interactive Investor, who have been leading the way in platform terms regarding ethical investing and fund research. So it's going to be a great piece. We're going to talk about how you do it, the pros and cons, the problems, the solutions when it comes to ethical investing. And you're going to learn a hell of a lot from that discussion. It doesn't matter how much money you have. You don't have to be wealthy to invest ethically or to try and combat climate change. And it doesn't have to impact your returns on your portfolio. So it's something that's gaining increasing popularity among investors. So we want to do this event. It's 7:30 p.m. Monday the 30th of November. For more information, go to moneytothemases.com/events. And so next week on the show, what we will do is take the edited highlights from that particular event, that live event, and we will condense it into a show for next week's podcast. But of course, it won't be the full event, which will be an hour long. So if you want the full event, then you can obviously watch it live on our Facebook and YouTube channels. So yeah, Andy, I'm absolutely buzzing. But obviously, we need to crack on with this week's podcast.
Yeah, what is it we're going to be talking about this week?
Well, perhaps depressingly so, I'm going to be talking about protecting yourself upon divorce. And I'm not just talking about personally, but also from a Brexit divorce, because one of the pieces is covering pensions and divorce. And whether we like it or not, lockdown is increasing the number of divorces. We're coming up to Christmas, and slightly depressingly, divorces increase in number after Christmas. It probably will be even worse this year, which is sad to say because of the lockdowns and all the problems that we've been having. So I wanted to talk about pensions and divorce because it's something that is often overlooked or not well understood. I want to do a very almost short FYI on what's going to happen with protection on investments, and in particular the Financial Services Compensation Scheme. After the 30th of December, there's a real danger that investors are going to have their money invested right now in funds that won't be protected if those funds were to go bust. It was inspired by a discussion in the Facebook group. So if you're not a member of the Facebook group, go to facebook.com/groups/money to the masses and join the thousands in there, helping each other, discussing money, finances, and generally just being an all-round positive, great place to be. But I had some emails following that discussion in the Facebook group, so I wanted to do a quick piece on that. And the other piece is the investment piece, which could be the meatier of the pieces that I'm going to do, which is how do I sit down and evaluate and assess a new investment proposition out there. So take a robo-advice proposition. When they come along, they're being launched all the time, and they're being launched particularly aimed at millennials. And there was or is one that's been launched based around ethical investing, making it easy to invest ethically, even your change, so rounding up your change when you go and use your card in the shops, that change can be invested ethically. And I see these propositions, they come to the marketplace and I look at them and I or the team review them, and I'm going to explain to people how I do that. And it's really how I assess whether something's good, bad. I think people would get a lot out of that piece.
Great. So you say that's the meatier of the pieces. Is that something that we're going to start with?
No, I'm going to change it up this week, Andy. I'm going to do the pensions and divorce this week. So I'm going to start with that. Yeah, this is just an overview of the rules for people, and it's mostly focused around England. I mean, the rules, for example, with Scotland are very similar, but there's small nuances that are slightly different. But I'm going to focus on England. And when I talk about divorce in this piece, I'm also including if you dissolve a civil partnership. So the rules are the same. I'm not going to say if you divorce or dissolve a civil partnership. If I say the word divorce, I'm talking about both. Now, if you get divorced, then you should ensure that pensions are included in your financial settlement. And that's even if you agree on a financial settlement yourself amicably. It should be confirmed through a court order. And that's because obviously when you get divorced and you start to divvy up assets, that you have as a partnership, then some people might not think about their ex-partners or soon-to-be ex-partners' pension that they have in their workplace. Because you don't see it, it almost feels like it doesn't really exist as an asset in some way. And that could be a final salary pension. So it might not even be a pension pot where they have been putting money every month that is actually easy to judge how big it is. It could be a final salary pension that they have, for example, if they work in the public sector. So the first piece of advice, if you're going to go through a divorce, then you should always get legal advice, obviously, but especially in relation to the pensions, but especially if you are remarrying and you haven't previously agreed on a financial settlement. Courts will deal with pensions in one of three ways. They can divvy up the pension asset via something called a pension sharing order. So the spouse who, let's just assume in this instance, there will be one person within the marriage has a huge pension pot and the other one doesn't. Then what would happen is a court could decide to issue a pension sharing order where the spouse will be given a percentage share of a pension pot. So they will effectively be given a chunk of the pension that will be designated for them. How that will work is it will probably be expressed as a percentage. In Scotland, it is usually expressed in pounds and pence. And what they do is they work out a percentage amount based on the transfer value calculated the day before the pension sharing order comes into effect. Now, that pension credit can be transferred into a new pension, or it could be included in the existing pension scheme that the spouse is already in, so the one that's got all the pension pots. Now, they may have to move out of that scheme as well. They may have to transfer elsewhere, but all you've got to be concerned about is in a pension sharing order, you will get a percentage of your spouse's pension, and it can be designated as a pension credit that will go into a new pension possibly. Obviously, if you've both got pensions, they're going to look at both scenarios and weigh up and do the valuations. Now, when they do valuations on a defined contribution pension, it's pretty straightforward because there is a pot of money that you see on your statement that you're putting in. Defined benefits is slightly different because obviously defined benefit schemes and final salary schemes is the same thing. They are based upon your longevity, so your length of service at the company, your final salary and the scheme and the way the benefit is calculated in the accrual. So what they have to do when they value benefits of any kind in a divorce, they have to work out what the value is. And it can be a case of a transfer value. It can be a case of they look at the income in retirement. So what possible income could each spouse get once they get to retirement, and how can we equalize that income? It will take account of like your ages, for example. The court will take into account obviously the length of time you've been married, and they can in some instances, let's say you were cohabiting for a period of time and then were married for an extended period of time, they can technically take account of the cohabiting period as well before that marriage. So the point is that you need to get this valued, and when you go and see a solicitor, they should be able to appoint somebody who has an expertise in valuing these pensions and therefore be able to come to a conclusion of the value and how they could be split. So as I said, you can get a pension sharing order where it will say a percentage of the pension will go to you. You can do something called pension offsetting, where the value of the pension is offset against other assets. So for example, a house. They may have a divorce go through where they say, well, one party keeps the pension and the other one keeps the house. Very simplistic example, but you can have pension offsetting. Often, some solicitors don't like the offsetting route because pensions are quite nuanced. They have different benefits. One pension, especially in the final salary arena, comparing to another pension is quite difficult. And that whole how do you value a pension problem is something, and be fair, is quite a difficult one to solve. They can obviously solve it, and they do. So sometimes they like to treat the pension as something very separate, and they will just do a pension sharing order. So they'll deal with the pension in a separate entity and then look at the other assets. You can also have something called a pension attachment order, or people might hear of it called pension earmarking. That's what its name used to be. So what happens in this third example, the court could decide that some of your pension is paid to your partner, a bit like maintenance payments. So that can be from their retirement income, or it can also include the pension commencement lump sum, or what people call tax-free cash. So you have three routes there. The pension sharing order, a chunk of the pension is moved into normally a new pension for you. There's an offsetting that occurs that can take account of other assets, or you can have this pension attachment order where you get to retirement, there's almost like maintenance payments going on where it's paid out of that income. So three different routes, and it will depend on what your solicitor decides is the best route for you. Now, state pensions are a different beast altogether. The basic state pension can't be shared, so you don't get a portion of your ex-spouse's state pension. If you get divorced, then you can use your former spouse's national insurance contribution record to boost your own pension, but it won't reduce theirs, so it won't impact their state pension that they get. If there is an additional second state pension, so in the past, if you retired before April 2016, there could have been an additional state second pension. So the way that works, you don't want to dwell on it, but previously, based upon your earnings, there could be additional contributions put into this second state pension that sat on top of the basic state pension. Now, that could be shared by a court order. Now, obviously, we've moved into the world of the new flat state pension. Again, that is just treated like the basic state pension in terms of you can't share it. Now, if you get married or you get remarried or enter into a new civil partnership, you lose these rights that I've just described on a state pension. So it's something to bear in mind. And I have had an email in the past from somebody who was elderly, and they'd obviously found love later in life, and they're then pondering whether they should actually get married, or should I say remarried, because of the impact it could have on their state pension. So it's an interesting thing to bear in mind. It's not just about when you get divorced, some of this stuff, it's about what could happen if you get remarried. So that is an overview of the pensions and divorce rules. Like I say, seek advice if you're going to get divorced. But the message is, if you know somebody who is going to go through a divorce, or you are possibly going to have a divorce, then don't forget that pension. If you seek advice, they will tell you about making sure you understand the pension benefits and they are split. But that is taken into account, so you will be looked after later in life. But of course, like I mentioned before, if you have a generous pension yourself, which happens in some cases, maybe one spouse worked for the public sector, one has a private pension, then they are going to take account of both pensions. So it's not obviously just a one-way street.
Okay, so moving on to the next meatier piece, and there are more and more investing propositions that are popping up from time to time. And Damien, you're going to explain the process that you go through in order to try and look under the bonnet of these people to see what they're all about.
Yeah, I mean, it's interesting because obviously at Money to the Masses, we're expanding as a team, and there's more of us now, and I drive the editorial process that goes on at Money to the Masses and how we look at things. We do lots of reviews now, not just of investments, but things like credit cards, and it's how we do that that's important. And obviously, it's always historically had been me. I would look at these things and look under the bonnet. And this week, there was a new investment proposition that came out. And funnily enough, the Daily Mail, or This Is Money, wrote about this particular proposition. It's called Ticker, Tickr, I think, and it is a app-based investment proposition. So think of like a robo advice proposition, but there is no advice in it, that is aimed at helping people invest ethically without the jargon. So that's the sort of press release, and you see these newspapers, they run with it, they sit there and write the piece, and it just seems like a big promo for the proposition. Now, I have no issue with that if obviously the proposition is any good. How we look at these things, I might see something like that and go, that's interesting. There'll be people out there who will start to ask me, what do I think of it? So I started to look at it, and one of the team was going to write about the particular proposition. And the process I use is the same, whatever the proposition is. And so I found myself to explain to them how I would look at it. And I realised that people on the pod might actually find this quite interesting. So first thing, I'll probably miss bits and pieces on this explanation. It's not a sort of complete exhaustive list of how I do it, but this is a rough process I go through. So this isn't about scams. This is about things that are legitimate enterprises. Because funnily enough, I had emails in the last week about Mango Money Markets. Is a proposition somebody said to me, is this any good? Should I invest in it? Just as an aside, as a rule of thumb, just write a company name and write the word scam into Google, and you can very quickly normally find something that shows that this is probably not legitimate. I mean, it's not foolproof, but when you did that, you found the FCA's warning on that particular company. They were offering investments, and they're not authorised to do so in the UK. And often, if something's too good to be true, it normally is. There's another one out there, Lannister. The FCA put out a warning about this particular fintech company, which is using influencers on Instagram to promote this new bank card. It doesn't actually exist. And if you look at all these influencers, I'm sure there were even footballers on there, Premier League footballers, and somebody waved that under my nose and said, what do you think of that? And I said, well, looks like a scam to me. I'm not saying it is a scam, but the first thing, it sets the alarm bells ringing. The FCA put out a warning about that as well. So all of these things you've got to look at with a cynical mindset. So the first thing I would do is go and check on the FCA register that the company is authorized to be doing the activities that it is. So in the investment world, that could be arranging investments. They should have an FCA number somewhere on their site that you can go and check. Obviously, that should therefore lead on to you checking whether your money's covered by the Financial Services Compensation Scheme, which obviously links quite nicely to our last piece on the pod this week. Check that your money is. They're basic checks. Now, I'm now talking more about looking at the proposition itself. Is it any good? Now, the first thing I would do is look for the problems. Ignore the hype. Look for the problems. If you want to use an analogy, think about going around and viewing a house. So you've got the estate agent with you. You've got the details that are telling you in this sort of luxurious, idyllic, quiet cul-de-sac that this house, all that nonsense that they put on the particulars. What you're looking at is the measurements of the walls and all those details, looking at if there's any damp. You're going through and doing that rough checklist in your head. What is the problem that they're not telling me about? Or what are the details that I should be more concerned about? Now, in the investment world, what I would tend to do is look at the overall what they're trying to say, and look for the comparison within the market. So, I mean, I'll take this ticker company for an example. Very quickly, when I looked at the proposition, I worked out that they were trying to place themselves as the ethical version of Moneybox. So that's the app whereby you can spend money on your credit cards, bank cards, and you can then round up the change and you can invest it or save it into a cash account, which is a great idea that's had a lot of funding go through it from investors, in terms of like talking about not investors investing the money in funds. They've had a lot of that too, but I'm talking about like angel investors, seedings, and etc. So already you can see if that's where they're placing themselves, then some of the pros and cons of that particular proposition are likely to be mirrored into this proposition, this new one. So I looked at that. How does it compare to Moneybox? I know Moneybox's flaws already because I've already looked at it. So it's a bit like if you go and look at a house and you may look at it and the surveyor may go round it. And this is a true example I'm going to give, by the way. I hope Justin doesn't mind me giving this on the podcast. And Justin found a house that he liked, had a surveyor go round it, and the surveyor said, yeah, this house is great. There's nothing too much to be concerned about on the survey. The surveyor then turned around to Justin and said, one thing I would say, though, is that houses that look like this, that I've surveyed in the past, often there's a quite high chance they've got asbestos in the ceilings, and that's quite out there. You're like, okay, I hadn't really thought about that. Cut long story short, Justin then got somebody in testing all the ceilings in this house he wanted to buy, that he decided that was the house for them. Every ceiling had asbestos in it. It then led on for him to be able to then make a decision based upon that and whether he would want to buy the house. What the surveyor did was he used some knowledge of another product and compared it and said, I think this could be a perhaps an issue. So, for example, Moneybox. The biggest issue with Moneybox is they charge a monthly fee if you invest with them. So if you don't do the cash alternative, you don't round your money up or invest money, put it in cash, you go down the investment route, there's a £1 a month fee. Now, this same proposition used that charging structure. It's expensive. Whatever way you look at it, a £1 a month fee is expensive, because if you're only putting in small amounts of money, put £10 a month in, that is a 10% upfront charge. Yes, you can put in more money into the proposition and it makes that charge get smaller, but why would you do that? So already the red flag was there for me that this charging structure, I don't like it. It's expensive. I looked at the annual fees. So you look at the annual fees. What will happen is propositions will often go with a headline, the total cost of 0.83% per annum. And it looks great. It's a sexy headline. They sit there and think they compare it to a fund that will charge 1.5% perhaps per annum, or maybe another robo-advice proposition that's charging 0.91%. And it's a very good headline figure. What you need to do then is grab that figure and break it up. Look at what the charge is for the platform and what is the typical charge for the fund, because none of these propositions that come to market will be investing using their own funds. What they will do is go and get a Vanguard or a BlackRock of this world, and they will, in a way, white label, give a great bit of marketing spiel, and they will create a portfolio or a fund of a name for usually a portfolio, which will invest in the underlying funds provided by the well-known fund management companies out there. So in doing so, there will be an annual management charge that you will be charged as an investor, and there'll be a fee that that company, the proposition I'm talking about, will levy on top, which comes to like that 0.8% or whatever it is. So break it down so that you find out what is the platform charge, the administration charge that the new proposition is charging themselves, because then you can go and compare that against the big boys out there, the Hargreaves Lansdown or Interactive Investor of this world, which charges a fixed fee, and say, well, how does that compare? And if I was going to buy that underlying fund myself through one of those existing platforms, which are well financed, they've been around the block, they're FTSE 100 companies, will it be cheaper or more expensive than buying it through them? Quite often you can find it will be marginally more expensive, because by giving you a smaller choice and a bit of clever marketing, and it's all based upon how easy using it is, you probably could do it cheaper yourself. Now, that is one point. The other thing is go and find the ISIN codes of the fund. So they are the car registrations of any fund that's out there. Sometimes it's difficult to find them on these propositions. Just get rid of all the gumph, the names that they call these things. Just go and find the fund fact sheet. It'll probably be a BlackRock fund or something like that, and it'll be some obscure fund that they run. And then go and find that fund online via something like Morningstar or Trust there, and then you can see the past history of that fund, because the proposition may have only been around for 6 months. So this new robo-advice proposition may only have been around 6 months. But the funds that they're using are normally from a partner. They normally only have one or two partners go within investment houses. And those sub-funds in their portfolio will have existed probably for years, or there will be a mirror of a fund that investment house has run for years, and you can find it, and then you can map them. So even if it's a fund that seems, it's probably only new, it's probably a mirror of one that fund house has been running for decades. Because don't forget, the fund house isn't going to keep launching brand new funds for every fintech firm that pops up every 5 minutes. They're going to allow them to invest in something they've already got that's being managed cheaply anyway. So you can chart the fund that the investment proposition is using against maybe one that's in existence with the investment house if you can't find the exact one for some reason. But normally, get the ISIN code, you can find the fund that you want. Look at that fund. Look at how it's performed. How has it performed against its benchmark? How has it performed against its peer group? And then immediately you can actually look and sit there and think, well, this robo-advice company is giving me access to this limited number maybe of funds. I could maybe get it cheaper elsewhere. Maybe I can't. If I can't, great. What's the minimum investment? Are they making the minimum investment so high that I'm kind of being coerced to invest more a month than I wanted to? Yeah, I could have gone through maybe Hargreaves or someone else and actually could invest a much smaller amount a month. Is the investment overall any good? So am I being presented with some choices that are pretty subpar in the investment world? I know you'll always see the caveat and the warning that past performance is not a guide to future returns. But you have to ask yourself the question, if past performance isn't a guide to future returns, then what is? And so you have to look at how things have done to make an assessment. If something's underperformed for years, what's going to suddenly make it change now? So you can very quickly see that despite a proposition being apparently new, you don't have to believe the marketing gumph like the newspapers do. You can make a very astute and well-reasoned review of a product. The other thing I would do is when you do the risk profile on these platforms, try and break it. Go back and forth. Choose low risk. Say you're a low risk investor. Say you're a medium risk. If there's questions you go through on the questionnaire, keep going back and changing them. And then map out all of the portfolios you could possibly get. Screen grab it. And in nearly every computer now, you can take screenshots of your screen. So just keep going through it and go back and forth. And eventually you can work out how many portfolios they actually offer. And normally they'll come up with, they'll say they've got like loads. but really they've only got probably about 3, and there's tiny tweaks they do to them. So you can see the asset mix. So you can sit there and go, well, this is what I'm getting from this proposition. I've got 3 choices. And actually, I could go and get a tracker over here from this proposition that's cheaper, and I could do exactly the same. So you'll cut through that marketing gump, and you can really see what they're doing for the money that you're giving them. So what sort of risk profiles you have, what sort of portfolios, what the range, how well researched is this particular tool. If you can't jump back and forwards and they're not showing you everything up front so you can make a well-reasoned research decision, then I'd steer clear and just go, well, why would I do it? Why would I go there? I don't know what I'm buying. This is a serious amount of money. Why would I want to buy something from somebody who's not showing me every permutation and portfolio and what the underlying funds actually are? And of course, like I said, you're going to find the alternative competition for the proposition that is just launched. Go and look at their portfolios and how they're doing in the similar risk bucket to the ones that they're giving you to see how they've fared over a period of time. And what it will do, it will actually start to make you look at the wider market. So all you're trying to do is pigeonhole this particular proposition somewhere in the marketplace. Where do they live? And then you know how they compare, and then you can see whether it's any good or not. And so very quickly, you can make an assessment, a full, very good review, in fact, of an investment proposition. Journalists on the whole won't do that because it requires a lot of work to do it and understanding. But if you're going to put your money into something, why wouldn't you do that is my question. So there you go, Andy. You're working out what people's USP is. Most of them don't have a USP, and how it stacks up against the other propositions out there and whether it's actually any good. The information is there. You've just got to try and piece it together.
Okay, and on to the last piece of the pod this week, and we're talking kind of another type of divorce, really, isn't it? Brexit, and how the changes that might come about through Brexit or will come about may affect certain things like FSCS protection in investing. So, Damien, you've got a piece on this.
Yeah, so this piece is in relation to Brexit and the end of the transition period that we've got with the negotiations between the European Union and the UK. Now, I don't tend to do pieces on the podcast until they become set in stone, until they're fact. And I don't tend to talk about possible rule changes or something that might happen, only because I think you scaremonger people a little bit. But this one is a little bit different, and I think it's worth pointing out. And it's because, as I mentioned at the beginning of the podcast, it was inspired by a post in the Money to Messes Facebook group that caused quite a stir and got a lot of interaction. And then some people wrote to me separately and said, like, basically, what the hell is going on? Can you sort of say something about it on the podcast? Now, the transition period for Brexit, the time's running out. So basically at the end of the year, that period ends, and the European Union and the UK are in ongoing negotiations relating to rules and regulations centered around the movement into 2021. Now, one of the things that it's going to have an impact on is the protection under the FSCS, so the Financial Services Compensation Scheme for investments. And it's been pointed out that there is probably there's £60 billion worth of money being invested in tens of thousands of funds. So we're talking about investment funds, things you would hold maybe directly in your ISA, in your pension. And apparently there are about 12,000 of those in total that UK investors have access to. And the Treasury has confirmed that about 9,000 of them that are currently available in the UK and will still be available in the UK going forward will not necessarily be covered by the Financial Services Compensation Scheme if there isn't some agreement made between now and the end of the transition period, so into next year. So it would mean that almost overnight, about 9,000 funds, which a lot of investors hold within their pensions, will no longer be covered by the UK's Financial Services Compensation Scheme. And the reason for that is the FCA won't have regulatory oversight on them, but it's because we haven't yet agreed a reciprocal arrangement between the UK and the European Union. It's called passporting of these investments into the European Union. So basically, in a roundabout way, what that means, when we were in the European Union, what would happen, investment companies might domicile a fund that was sold in the UK, but it basically was domiciled, centred at a place. It could be, say, Dublin. It could be somewhere in Luxembourg. And the reasons they might do that is for tax reasons, cost administration, number of reasons why it might be sensible to have it domiciled in one place that won't necessarily be the UK, and then be able to have those funds, sell those funds throughout the European Union. Of course, now we will leave. What it does mean is that the rules in place that meant that those funds would be covered under the Financial Services Compensation Scheme in the UK, because the FCA also had that regulatory oversight on them, then that breaks. And it doesn't mean you'd have no protection going forward. What it means is that you would have the protection of certain protection schemes in the European Union. So if the fund went bust, whereas now you'd have recourse of up to £85,000 from the FSCS in the UK, let's say, I don't like to pick fund houses, but let's just say Vanguard. So Vanguard went bust and basically they've disappeared. It all collapsed. Then if you had £50,000, say, as long as it's under £85,000 in a fund with them, then you would get that money back. And that is the point. You were covered up to £85,000 under the FSCS. What it means then is that for individual investors, they will suddenly become exposed to this kind of, or they potentially could do, this lack of protection on their pension funds, in their ISAs. So the message is, if you have funds, we've got to hope that they come up with some arrangement between now and the end of the year. In the new year, you might need to talk to your investment platform, your financial advisor, and ask what the latest is on this rule. Has it been sorted out? Are all your funds covered by the FSCS? If not, then you might want to do something about it. Now, it does impact, lots of the big players. So you think of Tilney, Best Invest, Schroders, BlackRock, Vanguard. All of these companies have substantial numbers of their funds domiciled in other countries. So what you want to do, even in the interim, you could go and look for the fund fact sheet of the funds that you hold within your pension, ISA, or just directly Google them, find the fund fact sheet, look for the domicile on that fund fact sheet. If it's in the UK, you're fine. If it's not in the UK and it's in somewhere in the European Union, then you may fall foul of the rule change. And Vanguard, like I say, is one of the companies that could be impacted. I can tell you for now that the life strategy funds aren't impacted. They are domiciled in the UK, so there'll be a lot of people I know use those funds. So you'd have to look at them individually. Doesn't mean you necessarily have to take action right now, but it's something to be aware of, because I know not necessarily everybody is in the Facebook group and didn't see the thread. But going forward, perhaps we'll cover this again in the new year to see what did come of the rule change. Did the government actually negotiate some form of reciprocal arrangement? But it's something, just an FYI to be aware of, questions to ask your platform, your financial advisor, or to look at yourself. Because at the moment, it's not clear whether platforms like Hargreaves Lansdown or Interactive Investor, whoever it is, has the obligation to tell you about the removal of the protection if it does happen in the future. But something to be aware of.
Okay, so that's it for this week's podcast. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. And again, a lot of today's show was on the back of things that were mentioned in the Money to the Masses Facebook community group. If you want to get involved over there, if you haven't already, why not? It is facebook.com/groups/Money to the Masses. And as always, would really appreciate if you could review this podcast on your platform of choice. It helps us to rise up the charts and help more people. Damien, I think that's it. We're done.
We're done. It was an action-packed, well, it's not action-packed, but content-packed show this week. So, yeah. I'm off to have a lie down. And, until Monday or next time.
Yeah, until next time. And actually, you've just mentioned there, Damien, if you want to get involved and sign up for that event, it is moneytothemasses.com/events. Until next time.